Good afternoon, everyone, and thank you so much for joining the earnings conference call for quarter ended 30th June 2020. I do hope you and your loved ones are safe and protected in these troubling times. Before starting my presentation, I would like to state that due to the unprecedented impact of COVID-19, the performance of Qtr1 FY21 does not represent normal quarter operations and is not strictly comparable with previous quarters. As we are all aware, with the pandemic continuing and the lockdown norms easing and then tightening repeatedly, an environment filled with fear, insecurity and economic hardship has become our current reality, and as a company, we are also learning to adjust to this. In the quarter under discussion, we know that COVID-19 pushed the world's economy into a tailspin, and the Indian economy and all sectors suffered hugely in this period. The media and entertainment sector was badly hit by the sudden stoppage of supply as well as consumption of goods and services of advertisers during the lockdown. The radio industry, like the rest of the media industry, registered a degrowth of more than 75%. I'm happy to report that Radio City was able to perform better than the industry, which resulted in us improving our volume market share by 2% from 19%, which was the market share at the end of FY20, to 21% in Qtr1 FY21, which helped us regain our leadership position amongst all operators and their main frequencies. This was possible due to several concentrated efforts put in by the Radio City team, and I would like to share the same with you. Firstly, there was an increased focus on tactical deals like the coronavirus awareness campaigns that we ran, special day promotions, etc., which helped us garner more than 30% of Qtr1 revenues across nearly 980 clients. During this quarter, the radio industry itself witnessed a new client base of 1,000 advertisers using the medium for the first time, which augurs well for the entire industry, and we at Radio City were able to capture the highest share of 36% from these new clients. Due to the aggressive efforts put in by the team, Radio City has also locked in long-term deals aggregating approximately 25% of our last year's business, which gives us some decent visibility for the coming quarter. We continued our further initiatives to reduce costs to make ourselves more agile and actually reduced a large element of fixed costs which will not come back. During the quarter, we were thus able to reduce our operating costs by 17.8 crores, which is a reduction of 38% as compared to the similar quarter of FY20 and 29% as compared to Q4 of FY20. Coming to the financial numbers, the revenue for Q1 FY20 are 14.4 crores with an EBITDA loss of 15.2 crores and a net loss of 13.9 crores. On the balance sheet front, again, we worked very hard to improve our collection efficiency, and I'm happy to say that we have improved our collections by 9 days, which was a very significant feat by the team given the liquidity issues that are being faced by everyone in the market today. The overall result of all these has been a strengthening in our cash reserves by 19 crores from 220 crores as on 31st March 2020 to 239 crores as on 30th June 2020. You will also remember that after our last loan repayment made in March 20, we are a completely debt-free business. I'm sure you will agree that there are very few businesses currently which are in this position and have such a strong balance sheet. Finally, when confronted with these unprecedented and difficult moments, I think it is a matter of emphasis and important for me to mention once again to all of you that we at MBL have strongly believed that a bottom line and margin focused approach creates maximum stakeholder and shareholder value, and we have been ardent advocates of this approach all through our business journey. Earlier, this led to us not spending on high-cost multiple frequencies or unduly focusing on building low-margin businesses like events and activation. There were a few critics of this prudent approach. However, I think the events that have unfolded over the last 2 years, and especially during this crisis, have only proven that it is always better to be an ant rather than a grasshopper. The annual results, which you would have all seen of 1920, have proven this strategy works without doubt. When compared to our national peers, while our revenue may have been half of theirs, our PAT was better off by 2.5 times their PAT. Equally, our low fixed cost in terms of depreciation, which is just about 38% compared to people who invested in multiple frequencies, will most certainly help us move back to profit faster and quicker. As we move towards the festival period, what gives me hope is the fact that month on month, our inventory utilization is improving. And even in June, as compared to May, we had an improvement ranging from 19% to 200% in different markets. For the radio industry as a whole, the inventory utilization did improve and the degrowth fell from around 80% in April-May to approximately 60% in June, which augurs well for the future. With this, we will open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Thanks for the opportunity. So in 1Q, industry volumes were down by 75%. How has the performance been so far in July till date? Is there any sign of recovery?
So as I just explained that on an average, the industry's degrowth was around 75%, and you're absolutely right in that figure. However, if you see April to June itself, so in April and May, when the lockdown was at its most severe, the degrowth was around 80%, which has now fallen in June to 60%. So clearly, even in June, we are seeing a recovery. Similarly, if you see Radio City's performance, again, the degrowth is steadily going down. So from the 80% approximately in April-May, Radio City is down to around 50 to 53%. And obviously we expect this to continue even in July and so on. And as the festive season comes closer and more of the lockdown easing happens, we are sure this number will only better.
Okay. So in 2Q, do you expect the volumes to be better than what they were in 1Q? Because the degrowth was 75%. If you can just call out a number or give some indication as to how the performance explicitly was in the month of July till date, that will be really helpful.
So again, I'm repeating the same point. I'm saying that April and May, the degrowth was 80%. In June, it fell down to around 60% for the industry and around 52% for Radio City. This trend is continuing. So as of now, what we see is clearly yet another 10% improvement in the volumes for the industry and for Radio City. I hope that is clear.
Yeah. And secondly, are the yields on the long-term deals that we have signed in this quarter lower or similar to the pre-COVID levels?
So we have signed around 25% approximately of long-term deals if you look at the total number last year. But clearly this whole year it is expected to be muted in terms of the rates. So broadly, one can anticipate that on an overall basis, the rate degrowth, which has been approximately 8%, is what will play out both for the long-term deals and for tactical deals.
Okay. And one last question. Our total operating cost in this quarter was approximately 30 crores odd, if I'm not mistaken. So will this rate sustain going forward, or are we headed back to the 45 to 50 crores kind of figure which was prevailing pre-COVID?
We've saved approximately 17.8 crores in quarter one. Half of that has been fixed and half of that saving has come from variable cost. If the situation improves, then the variable cost will come back, but the fixed cost is a permanent saving. If the situation doesn't improve, then even the variable cost will not come back.
Got it. Thank you so much.
Thank you. The next question is from the line of Sachin Shah from MK Investment Managers. Please go ahead.
Yeah, good afternoon, ma'am. Thank you for this opportunity. What I would like to know is that you did mention that we have seen in the month of June industry down by about 60% and probably music broadcast at around 52%. Compared to that you talked about the radio industry, but if we see the other media, say particularly the television media, have they recovered better than the radio overall as a market in the last June and July per se? And did they drop also less in the months of April and May?
Broadly, if I were to separate out all the media performance in terms, and I'm talking specifically only of ad volumes, I would say that television and digital degrowth has been approximately 50 to 60%, whereas radio and print has been around 75%. So both digital and television have done marginally better than print and radio in terms of volume. Their degrowth was lesser. Within television, the ad volumes went to mostly the news channels because the GECs were running repeat content and not original content. On digital, most of the ad volume went to, again, news, wherever there were gamification sites, because that's where there was more reach, and partially to education. This was the way the volume degrowth and spread happened.
Okay. Just one thing on the similar lines, kind of interconnected. For radio, we generally do not have too many of national advertisers, whereas it's more about region specific. Whereas on the television, probably we will have more like a national advertisers or large companies. From what we are seeing at the ground level, probably the large companies are not so much affected, and probably the regional players or the MSME sectors will be more affected, or even some of the sectors like the real estate, which are more region specific, will be more affected. So do you see that trend that the television media will actually be faster in recovery versus the radio because of your customer profile challenges, I would say?
Actually, there are 2-3 assumptions you're making, and I would like to just correct those assumptions.
Sure.
Firstly, on radio, 60% of advertising has traditionally come from national advertisers, 40% has come from local. In the last year, with government not spending, this proportion had shifted to around 55 coming from national and 45 coming from local. So the dependence of radio is equally on national advertisers as it is on local advertisers. That's the first correction. On television, around 65 to 70% comes from national advertisers, 30 comes from local advertisers.
Okay.
Within television, on news channels again, local advertisers are far higher. So around 60% for news channels comes from local advertisers. Therefore, as I clarified earlier, this time the ad volume in lesser degrowth that we have seen in television is largely due to news channels. And this volume came in from local advertisers. Similarly, for the radio industry and for Radio City, a lot of volume has come from local advertisers. As I told you, 1,000 new advertisers got added to the radio industry. Most of them were local. What really has happened in Q1, and that is the third assumption of yours that I would like to correct, is national advertisers did not spend. The spending has come both for television and for radio and for digital, mostly from local markets and local advertisers. I think what has happened is local advertisers have seen an opportunity. They have seen that there was national advertiser supply chains that were broken. They were getting their act together in terms of how they themselves would work. Production had come to a standstill, and the local advertisers were far more agile and far more willing to spend. So I would say that Q1, whatever volume has come, it's mostly come for every medium from local advertisers.
Okay, that's very helpful. Just one last question is that has the advertisement rates dropped more on the television versus radio, and does that make that more attractive relatively?
The difference between radio and television advertising rates have been typically 7:1. So whatever drop anybody does, radio is always the most cost efficient.
Sure, but has the overall, like we've dropped about 7-8%, would the television would have dropped more?
I would not be able to answer specifically whether television has dropped. What I definitely do know is that the large volume that we saw on television was a mix of, as I said, the local advertisers and a lot of the follow-through of previous year's volumes coming here. So people had many volume deals on television. Part of it got extended into this quarter. So that will, when the numbers come out, that will clearly show that there has been a rate drop. But I would say that it has really been the bonus volume that has come through in Q1. So it would be not right to take calls for anybody on what has happened on rates. We're looking at this particular quarter.
Fair enough. Thank you. Just one last thing, and I'll take a little liberty on asking you this because it's a little bit of a peer group comparison. But the last quarter, which was the March quarter, one of our peer group companies actually delivered little better results than us. Any particular reason for that?
So I think the way to look at it is you can turn around and look at growth figures and say Radio City D grew by 20%, a peer D grew by 14%, etc., etc. I would not go by those quarter figures. The point that I repeat is to look at it at an annual basis and to look at it from the perspective of what are the profits that we are delivering. Top line buying, anybody can do. I can get 100 crores more added on top line at 0 margin or 5% margin or 3% margin. But as I have maintained that our game never has been about increasing our top line without being able to deliver the margins that we are used to. So I would request you and urge you to look at the profit figures, especially in these days. What are the numbers that Radio City has been delivering over the past several years? And what is the expectation on these numbers and how quickly we will be able to ramp up. And any business which has low fixed costs, as we do, I mean, just look at our depreciation. It's just 30 crores. It's barely 40% of any large player. So who is likely to come back to profit faster? I think those are the factors I would look at.
Sure. Thank you so much. This is very helpful and all the best.
Thank you. The next question is from the line of Jayesh Shah from OHM Portfolio. Please go ahead.
Hi, Apurva. Nice job, in a tough environment. Couple of questions. So the first one is this locking in the new advertisers to the extent of 25% of last year revenue. This is for what period? Is this for the balance 2 quarters or for the entire 4 quarters starting now?
Jesh, thank you for your feedback. The long-term deals that we have signed, which I said are approximately 25% of last year's numbers, are for the full year. And mostly they will start playing out. A bit of them have started, but mostly they will start playing out from quarter 2, when the advertiser itself is more confident that he has a market of consumers out there. So I would say 90% of this will actually play out in the balance 3 quarters.
Okay. So mathematically, Apurva, if you get another 25% locked in with any of these other advertisers, you would hypothetically cover your entire fixed cost for the year.
Yes.
Yeah, and I think if you bounce back to, let's say, 50% utilization, then effectively this lock-in will allow you to go to 65%, where you start seeing your normal EBITDA increase, which we have seen in the past. And I'm just talking pure mathematics.
Yes.
Okay. Nice to know. And bouncing back, and do you see any green shoots in terms of national advertisers or others getting more keen to you because of cost-cutting pressure?
The degrowth, Jesh, has clearly started going down. We can see that. So, and we can see that in June, and we can see that in July also. In fact, the markets that have bounced back very nicely are the smaller markets. So that's a very, if I see the visible green shoots, they are all there in the smaller markets, which is a very good sign. The bigger markets have started growing over April, May certainly, but the growth is much lesser, which is for 2 reasons. One is that the bigger markets are still under a lockdown situation as compared to the small markets. So whether it's a Bombay or a Chennai, which have shown the least growth for us, they are the ones who are continuing with the lockdown, right? So once the lockdown opens, we anticipate that the Bombay market, etc., also will bounce back nicely. So my answer to your question is, green shoots are visible mostly in the smaller markets where the lockdown situation is not there, not so much in the big markets. Again, it's mostly visible in the local advertisers who continue to spend even in these hard times. So the 1,000 advertisers that I'm repeating, which came in as new advertisers for the radio industry, or the 1,000 advertisers that we did tactical deals with, 80% of them were local. National advertisers, we've seen a bit of resurgence coming from specific categories like finance and auto, not so much from consumer durables and FMCGs.
I see. Very interesting. And Apurva, best of luck.
Thank you.
Very happy to see the work that has gone in the past quarter.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Apurva, so you said in the month of June you have seen around 60% below normal in terms of revenues. How are the numbers trending for July? Hello.
As I answered in my earlier question, I think one can assume that there still will be a degrowth, but as compared to the previous month, which is June, it will be a 10% improvement in utilization.
Understood. And secondly, in terms of your operating costs, so this license fee has remained more or less constant. So any work on that front, or is it going to be like this only for the remaining part of the year?
You mean license fee as in what we pay to the government?
Yeah, which is captured in your P&L.
Yeah. So that is a fixed cost kind of a payment that we have to make to to them. We have been pleading with them to give us a waiver as an industry. As AROI, we have been writing to them, talking to them, meeting them, and while they have been very sympathetic towards our cause, as of now what they have done is given a 2-quarter waiver. Postponement, a 2-quarter postponement. We are pushing for a complete waiver for a full year.
No, 2-quarter postponement means it is just a cash flow impact, not a P&L.
Correct. That's right.
Understood. And any updates on the RBNL deal?
There are no updates as such. The status remains status quo from the MIB side.
Okay, understood. Thanks a lot and all the best for the coming quarters.
Thank you. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. The first question is on a couple of slides that are talking about audience growth and the time spent on listening to the radio. So could you comment on the trends on those? Meaning during lockdown, obviously the numbers went up, but are the audience sticking around, or are you now seeing them sort of move away from the radio channels?
So during the 3 months, as you would have seen across various researches, the time spent on all media went up. Television went up by approximately an hour, radio went up by around 30 minutes, digital also went up by around 30 minutes, print went up by around 20 minutes. So with people having more time, they did spend that much more time on media. This trend, as of now, the latest data suggests that this trend is still on. It may change later, but right now, none of the media have lost this increased reach.
Great. My second question is on the categories that you have mentioned in one of the slides. So why did finance jump so much in terms of volume growth? And are you seeing any of these degrowth categories starting to come back? Which one is sort of coming back fast? Is education, now that we are sort of in the season, is that bouncing back, or other trends that you're seeing in different categories?
Finance, I would actually attribute it more to specific clients which increase their spend. And a lot of increase actually happened from insurance clients. So LIC and SBI insurance, etc. So that was the fillip that the finance category got, really, from life insurance.
Okay.
We are, apart from the categories that have spent in Q1, which has been finance and e-commerce and auto, July, I would say auto has increased a bit. FMCG has marginally increased, and pharma and healthcare has gone up. So these are the 3 categories. Finance continues to have high spends in July. Pharma, healthcare, and FMCGs have increased. Marginal increase in education also, and in government.
Okay. Thank you. That's all I had.
Thank you. The next question is from the line of Srinivas Seshadri from Mirabilis Investment Trust. Please go ahead.
Yeah, hi Apurva. The first question was regarding the pricing. So you said that there's a 8% difference between the volumes and the reported revenues. So if you could talk about the difference of about 8%, how much is it driven by, say, permanent reductions in pricing, some temporary kind of volume-driven incentives, and see maybe some mixed impact because of the type of advertisers you're getting in these circumstances? That's the first question. And on that basis, like prospective basis, will the volume and revenue spread remain similar, or do you expect it to contract a bit?
You're absolutely right, Sheshadri, that it's a mix of the local clients who typically would work at marginally lower rates and some of the volume deals that the tactical deals that we have given. So the Corona awareness campaign. So whichever advertiser chose to spread some awareness about Corona and what needs to be done, they were given special rates. So certainly there has been some part of it coming from tactical and such advertisers. Going forward, I would certainly assume that the rate decrease will go down from the current 8-9% to around 5-6%. But I definitely expect that through the year, when we look at the year in its entirety as compared to the previous year, there will be a dip of 5-6% in rates. So that is there to stay.
Okay, sure. And the second one was like you reported a good kind of a cash balance increase of about 19 crores, despite the EBITDA coming negative at about 15 crore. So I understand that about 4-5 crore of it comes from the deferral of the license fees, but even net of that, there's a good 30 crore kind of increase in the there's a difference between the operating loss and the change in the cash balance. So is it largely because of the receivables being collected compared to the fourth quarter?
Yes, in fact, the collection which we have done is better off reducing our debtor days by 9. So we collected approx 50 crore or so in such a given scenario, which helped basically gain this 19 crores of additional cash flows. In fact, the entire quarter, the focus, including the revenues being lower, was largely on to getting this collection in place.
Okay. You said 50, is it? 50 crores?
Yeah.
Okay. Got it. That explains. And of the government dues of about 40 crore which were there at the end of the last quarter.
Correct. We were able to collect 5 crores out of it.
Okay. So government still remains a larger...
Yeah, but at least we got something moving. Rather than earlier quarters when we discussed, there was nothing which moved.
Okay, sure. Again on the cash, like now it appears that from the next quarter onwards, the EBITDA gap may not be very significant, at least on a cash basis, you may be more or less stable. So the stock again, it's about like a very sharp depreciation from where we did the IPO and also the previous buyback about 1.5-2 years back. So is there any thinking around another round of buyback just to kind of make a more efficient utilization of the cash now that there is a window again available to do that?
In fact, in the buyback front, we had done a year back, more than a year back. So that idea is open. But however, the board has not yet decided what to be done. Of course, whatever... especially being part of Jagan, we will always do what is, more feasible for the investors.
Mm-hmm. I see. Okay, all right. Thanks for taking my questions.
Thank you. The next question is from the line of Ayaz Motiwala from Nivalis Partners. Please go ahead.
Yes, hi. Good afternoon. Thank you for taking my questions. I want to have a clarification on the 17.8 crores that you mentioned on the cost control over the comparable quarter in the last year. And you mentioned about fixed and variable component. I quite didn't understand it. So can you please clarify that on that between 50% and that 50% coming back?
Yes. So this approximately 18 crores that we have saved, broadly 9 crores has come from fixed costs. So there's been around a 6 crore saving in staff costs and another 3 crore saving in some other fixed elements like some marketing costs which were fixed. That's how that fixed cost, and since it's come from that base is not going to come back. So we will continually have this saving through the year. That was the point that I was making. As far as the balance variable cost is, that is again marketing costs and event costs, etc., which we have to incur to keep our customer engagement going. Travel costs, which have not obviously played out in this quarter. Those and other costs like royalty and license fee, which are partially linked to revenue. Those will come back as revenue improves.
Okay, that's very helpful. Thank you. The second question that I have is that I observe in the charts on the market shares. In a few markets, you are still not the number one leader, and there are other players in the close proximity of where you operate. So in terms of a positive takeaway, what are some of your competition doing in markets such as Delhi, etc., which you would like to learn and also improve your direction to gain leadership in these markets?
Our point always has been that as long as we are amongst the top 2 players, we will be able to garner revenues based on these listenership shares from our advertisers due to our superior sales team. So as long as we are in the top 2, we really are not too caught up in trying to be number 1 everywhere. That's the first point I would like to make. The second point I would like to make is that when advertisers spend with a particular player, they look at the listenership position or the market share that you are looking at. They also look at other factors, which is the type of programming, the TG that we are trying to address, what is our product strategy, who are the big RJs, etc. And we believe that on all these product parameters, on all the quality parameters and all the market parameters, we score very well and we are in a leadership position. So if if there is some other peer who is number 1 in, let us say, Delhi, but then he has only 6-7 markets to go out and offer to a client, whereas we may be number 2 in Delhi, but we have 39 great markets for the advertiser will prefer us. Okay, got it. And in terms of programming, I mean, is there anything that they are doing which you'd like to do which helps you to narrow that gap? Or, I mean, I take your first point on being 1 and 2 in each of these markets, but I would, frankly, we've never believed in looking at competition, and I say it in the nicest possible way, because each brand strategy has to be true and focused on what the brand's vision and brand values are. So if, for example, our brand values are all about local connect, rag mein city, emotional quotient, and let us say another brand's values are more about being in your face and aggressive, there's no point me copying their product strategy or they copying mine, right? We have different brand values. Okay. So that's how we've always believed, and I think if you see the history of Radio City and the kind of innovations we have done, rarely some other player would have done the same. Sure. And one question on the market situation on all mediums which have all gained shares, which you put out in your chart, and within that the focus on the radio business, which has resulted in both listenership and the quantum going up. So in sort of media terms, this is obviously a great news when things normalize on the context of monetization. So, Apurva, how would you look at life when things get more normalized? Do you think for whatever sticks in time, do you think you will be in a position to have better bargaining with your clients, not simply implying just better rates, but an overall proposition to them because the listenership is gone up so dramatically? You're absolutely right in terms of the fact that listenership has gone up and reach has gone up and numbers and engagement has gone up so dramatically for not only radio but for the entire media industry. So that is a fact of the last 3 months. I would like to just separate out what we are doing from two aspects. One is the B2C bit and the other is the B2B bit. That's how we operate. We have a B2C model where we are trying to get the maximum listenership and a B2B model where we are trying to get the maximum revenue from our advertisers. In the B2C model, for these 3 months, to increase our engagement with consumers, if any of you have listened to the radio station, you would have seen the huge programming pivot that we did in terms of associating even more deeply with our listeners during these troublesome times. In fact, the constant feedback that we kept on getting from our listeners is that there's anxiety and there's fear and there's loneliness, and radio with its emotional connect is proving to be a great companion for all of us. So a lot of activities we did to keep them engaged and entertained. Concerts from home, talking to them, our RJs talking one-on-one, giving them advice on how to deal with COVID and the anxiety that they're going through, gave us this increased reach. So our B2C engagement obviously has gone up manifold. Now we come to the B2B part of our business, which is our connect with advertisers. Obviously, the advertisers, their own markets were totally shattered. They had no, whether it's an FMCG or an auto, they had no consumption for the 3 months of the lockdown. The supply chains were broken, so they had no market for them to advertise to, and as a consequence, obviously everybody stopped advertising. So in this time, how did we keep connected with them? Because that's also an engagement that will help us when the situation improves. So there was a whole process put in place where each one of our 120 sales teams were every week in touch with our clients. So whether it was to just talk to them, whether it was to just tell them what is happening, whether it was to just update them on some health fact, or share the content with them. There was a whole customer relationship management program that was put in place, which may not have translated and would not translate into sales. But I think unlike many other organizations which were grappling for the first 45 days, what do we do? They had no clue. From day one of the lockdown, we ensured that each of our sales team remain connected through various ways with our clients, and I'm sure that will pay us dividends when things improve.
My last question, Apurva, this is very helpful, and I'm taking the liberty for this one, please. Is that the entire media business is obviously season and time bound, and if not the shape of the recovery on the type of alphabet, but if there is a pronounced recovery combined in the festive season, would you be in a position to have rationing and substantial improvement in rates? Because ultimately the key 5 to 8 p.m. or morning, etc., those slots are premium, and if there is a rush of advertisers because there is a opening up, etc., would that be a one type of scenario which is possible?
If that type of scenario plays out, we will welcome it with open arms, obviously. So clearly, we all hope that what you say comes true. As far as the rate improvement and rationing is concerned, I think the way to look at this year is not like the earlier years, where there was this whole festive season, there will be a peak, then Shraddh, there will not be a peak, then again, end of the year, there will be finance clients who will be advertising. So that seasonality, which is a seasonality of any other year, I would myself sort of not expect that kind of seasonality to play out this year. And I'll give you the reason why. Whether it is a consumer or a advertiser, everybody has been locked in, right? Now for 3, 4, 5 months. Post the opening out, and when people are feeling secure and get out of this fear psychosis, we believe what will happen is that pent-up demand, that pent-up consumption, what everybody is calling the revenge shopping a part of people's lives will come back. And you may be pleasantly surprised to see that if things even out, let us say in August or in September, the next 6 months, because even the advertiser has a target, right? He has an annual target which he has not been able to achieve in H1. So he'll put extra effort in H2. So we may be pleasantly surprised to see H2 completely not have a lull period at all. But of course, everything really depends on how this health scare goes away and when it goes away.
Great. Thank you very much and appreciate your time and all the very best. Thank you.
Thank you. The next question is from the line of Dipesh from Equirus Securities. Please go ahead.
Yeah, hi. Thank you for taking my questions. There were some news articles that many radio companies are thinking to surrender the frequencies that they took in the last auctions. So just wanted your thoughts on that. Are you thinking on those lines too, or are you looking to acquire them at the current distressed environment?
Firstly, I have not come across any article, and I don't know in the AROI whether anybody is wanting to sell or get rid of their frequencies. So I'm not aware of any such discussion or article. As far as we are concerned, even when we first took the frequencies, we were very, very careful and prudent that we wanted to expand our geographical reach. So we didn't go for multiple frequencies. We went for increasing our reach. All the 11 markets that we took have added to our reach, and not only that, they have helped us de-risk our model. And today, if you see, those are the markets which are, rather than the big metros with multiple frequencies, those are the markets that are coming to the rescue of the radio industry. So in that sense, all our markets are important, and our local markets, our new frequencies are becoming even more important in this new environment.
Sure. Can you give me the split of revenue that you saw in the last quarter in the legacy versus the phase 3 stations, please?
So, whatever 14.4 which we did, of it approx 12.5 came from the legacy.
Okay, right. Understood. And lastly, ma'am, just wanted to understand what kind of revenues the radio industry used to generate from the IPL 18 ads. And if the IPL happens in the second half of this year, do you think that there can be revival in the ad environment?
Yes, IPL, because a lot of radio stations associate themselves with the IPL, especially with the local teams, etc. If I remember right, the whole industry broadly gets around 2.5 crores from IPL.
2 to 2.5 crores.
Yeah.
Okay, thank you.
Thank you. The next question is from the line of Yogesh Kirve from B&K Securities. Please go ahead. Mr. Yogesh from B&K Securities, you may go ahead with the question.
I'm sorry, am I audible?
Yes.
Yeah. So could you give us a sense of the nature of the long-term deals we have entered into? So are these in the nature of option with the advertiser to put in volumes up to certain quantity at certain rate, or is there a commitment on part of advertiser to deliver so much of volume or seek so much of volume?
So there is a mix of deals. Some of the deals are based a particular commitment at a particular rate. Some of the deals are market share driven and therefore volume driven.
Okay, so we are. What is our comfort that this amount of volume would be used up by the advertiser?
If, as I'm saying, and seeing this recovery, which is a 10-15% improvement happening every month, then we are confident to the extent of around 95% that these deals will play out in this year.
Okay, that's quite helpful. Second is related to this. So are we now also proactively looking to get into more such long-term deals? And is it realistically possible to have sort of a 35-40% of last year's revenue covered under these kind of deals?
Yes, it's absolutely possible. We've done it in the previous years, and the entire team's effort is to reach 40%.
Okay. And thirdly, regarding the Apurva, you alluded to the rate of decline in ad revenues improving from May to June and expectation of it could improve further in July. So are these additional bouts of lockdowns we are seeing in some selected cities or some states? So is that impacting some way, or we remain confident of the improving trajectory?
Of course, it is impacting. This, as I said right in my opening, this constant opening and closing, locking and unlocking is a very, very bad thing that is coming in the way of economic recovery. Equally, it is coming in the way of the uncertainty and fear that is developing in people's minds. So there is no doubt that it is that is impacting, and I think it is up to the governments at the local level to figure out solutions.
Right. And finally, Jimmy, so you referred to the receivables coming off by 50 crores. So if I understand, it was 106 crores in March, so it has now come down to something like 55 odd crores, right, in June?
No, but you have to add back revenues for this quarter, right? So we'll end up between 75 or so.
Okay. And out of that, the government would be roughly about 35, 40.
35. Yeah.
35 crores. Okay.
Yeah.
Okay. That's all from me. All the best.
Thank you. We'll be able to take one last question. We take the last question from the line of Gautami Desai from Chanakya Capital. Please go ahead.
Yeah. Hi, Apurva. On the salary front, was there a cut across or did you lay off some people? Because I believe there was some amount done on that front on the pre-COVID levels also, when, I think you had stopped some increments and things like that. So why I'm asking you this question is that yours is a very, very people-driven and a creative field, and if we overly do it on the salary front, are we really compromising on the quality front? That is my first question. And the second question is, now with the pricing going down, say by 5%, and with your new cost structure with all your cost savings, what is the volume level at which we can be EBITDA neutral for the full year? I mean, you would have made some internal estimates.
To answer your first question, Gautami, the staff savings that you are seeing has primarily come from the productivity enhancement measures we took just around February, March, which started playing out therefore in April, May, which is the reduction in low productive resources, which is typically an exercise we do once in 2 years, and you will appreciate that this is when things are going easy, there clearly is some flap that gets created in any organization. So that is really 90% of our savings have come from there. The other 10% broadly has come not from any salary reduction, but from the incentives getting not paid out because the numbers were not delivered. And in our organization, unlike many other organizations, our entire organization has a variable, including the RJs and including the programming and production team has a variable component linked to the company's financial performance. So that is the component that didn't play out. There have been no salary reductions.
And no COVID-related layoffs or anything like that?
No. We did all our layouts in February, March. But obviously people's last days were because there was a 1 month's notice, etc. Or last days were happening from 15th March to, let us say, middle of April. Yeah.
Okay. And the second question is, when will we, what volumes will it be EBITDA neutral for the full year?
On a monthly basis, if we reach around 55 to 60%, we are EBITDA neutral, break even at a month level.
At a month level?
Yes.
Okay, so all we have to do in the whole year, then if we reach at 55%, say in July, and if we continue that, then all we have to do is, for the full year to be EBITDA neutral, then just make up for those months of April and May.
That's right.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Ms. Apurva Purohit for closing comments.
Yes. Thank you everyone for joining us in this earnings call. We pray and hope that the upcoming festive season will bring new cheer in all our lives and to the economy. I wish you all the very best. Stay safe. Take care of yourselves. Goodbye.
Thank you very much. On behalf of Music Broadcast Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.